Welcome to the Money Market Show. I'm your host, Paul LaJoy. The Money Market Show is sponsored by the Money Market Inc., the Amazon for mortgage solutions. On this show, we bring you very exciting people, okay, loan officers, loan brokers, who bring you account executives, who also bring you top real estate agents in the Bay Area. Today is Friday, so I'm looking very casual, but hey, we're bringing some stuff that is very serious too. But I'm excited to have on the show today my man Ray Lorraine and grandmother of the lender. Her name is Loni. The show, Ray and Noni.
Thank you, Paul.
Thank you, Joel. What's going on, Paul?
Okay, so Noni, we're gonna talk about you. So before the show, you just cracked me up a little bit, you know, and you spoke some French and you sang a song. Can we do some of that again?
Sure. So, I was born in Paris
What?
and raised in Brooklyn.
I know, c'est vrai?
I was born at né à Paris and raised in Brooklyn.
Alors, ok, je suis né à Paris, je suis grandi à Brooklyn, à New York.
Brooklyn, New York, and raised in Brooklyn. Habitat Brooklyn. Brooklyn. There was the Italian and the Jewish section.
Oh, really? Okay.
Really, yes. But I was raised on a block like that with all the Italian people and stuff. Yes.
Oh, okay, cool. Now, you did a song for us, okay?
Oh, well, it's La Vie en Rose by Edith Piaf.
Okay, can you do some of that?
I don't remember all of it. Let me think what I can remember. Oh. Quand il me prend dans ses bras, il me parlait tout bas, je vois la vie en rose. Il me dit des mots d'amour, des mots de tous les jours, et ça me fait quelque chose. Il est entré dans mon cœur, alors je sens un peu. I forget the rest of it.
Okay,
c'est Louis pour moi, Louis dans la vie. Il me l'a dit, le jurer pour la vie. Il est rentré dans forget, et de son en bas, mon cœur qui bat, la 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 la, la 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 la, mon cœur qui bat.
Très bien. Je suis tellement feliz. Je suis tellement feliz pour entendre-vous chanter la chanson là. Ok, c'est vrai, ok?
Je ne comprends pas. Je ne comprends what you say.
Yeah, so
you went too deep for this, old lady from Brooklyn.
Vous chantez en français, mais vous ne comprenez pas.
Chanter en français, oui.
Oh my goodness.
Joy.
Okay,
the joy. Love that.
I bring joy to people.
I know you do. Thank you for letting me sing a little bit of that song.
Oh man, you know what? We're gonna repeat this on Facebook Live, okay? Maybe that's okay. I was gonna do a Facebook Live.
Tell me whatever you want to do. You do whatever you want to do. It's fine with me.
No, this is the first show of many shows that we're gonna have, okay? This is the first of many shows that we're gonna have. So we're gonna make it 20 minutes. Okay, great. So, and one of these days, I can fly down to Southern California, and you guys you are from North Hollywood, so you have some Hollywood in you.
Yeah, certainly. You can see she's got a lot of Hollywood.
Yeah.
She's Hollywood. Okay, so I'll fly down there, and then you dance ballroom.
I do. I can dance. I can move.
There you go.
Wait.
We'll come down there. I'm a Fred Astaire graduate. Okay? Fred Astaire? I'm a Fred Astaire graduate. Yes.
He's a
So
first-year graduate
Oh
dancer.
my
Yes,
God,
yeah.
I'm a good follower. So
There
if
you
you're the
go.
good leader, I can follow.
So I'll
I'm
fly
a
down.
very good follower.
I'll fly down. We'll do some cha-cha, some
Oh,
salsa, some
I
boston.
love the cha-cha.
I'm pretty sure I can cha-cha.
I love the
I can
cha.
cha-cha.
Can you do the Lindy Hop?
Everything.
Oh my God, the merengue, the cha-cha, the
yes,
Lindy, the waltz.
Yeah, the waltz.
Why don't you go
yeah.
on Dancing with the Stars?
Yeah, Paul, go on
Paul?
Dancing with the Stars. Come on, man.
You know what? You know what? I had at one point, 2002, after I moved here, I had a girl. She was a university professor, right? At Pepperdine University, in Malibu.
Yes.
I met her on eHarmony, and she was a math.
Oh,
she was a
eHarmony.
She was a math professor, right? And she flew out here, met me, in Northern California. And she was nice, very, very nice. Okay. And then she said, Paul, why didn't you just come and visit me in Southern California? I never went, and for some reason, every time I talk to her, she's talking about math. For some reason I got bored from that. And it's like, God. But, so we broke up. Then I went back to Malibu, and I thought, oh my goodness, I saw all these people surfing, and all the Hollywood stars live in Malibu. I said, what a dumb, what kind of mistakes I do that I make? I should have really good.
eHarmony is a very good matchmaking service, from what I understand.
Yeah, of course, and she's a PhD in math. That means she is well educated and all that kind of stuff.
Wow, a doctor. That would have been good for you. You need a doctor, honey.
Exactly. One of those mistakes. But today, let's talk about Noni. So who's going to talk? Is it Ray or is that going to be you, Noni? Who's going to tell us about Noni?
What do you want to know?
Well, I'll introduce our beloved Noni here. So thank you for joining us, and thank you, Paul, for having us. So today, Paul would like us to focus on, here at the lender, our Noni, which of course is slang for grandma in Italian, as I'm sure all Italians know out there, but it also stands for non-owner, no income. So kind of what we talked about yesterday, one of the best things that, the lender and ownership, Corey Tone and Aaron Iverson and Shane all done, is we took a complicated loan, what was a DSCR loan, and rate sheets were all convoluted and crazy in 2020, and we made it easy. We rebranded it. And we made it for volume. We fund more or less than $200 million in Noni alone monthly. So rental properties, no income docs required, up to 85% LTV on a purchase for a 1 to 4 unit. And we do 5 to 8 unit financing now, which is a hugely underserved market. So, the realtors watching, and, if you followed us from yesterday, this is another innovative product that you can use in your toolkit in a very underserved market. There's not many solutions for 5 to 8 units right now. So we've expanded to 5 to 8 Noni, which is a huge deal. We've got Noni 65, which is for our first-time home buyers with at least a 680 FICO score, up to 65 LTV. And foreign nationals are allowed on the Noni. So we've got multiple facets of Noni. If the DSCR is there, if it's a less than 1 ratio, or that rental income doesn't cover all the mortgage, we've got a near Noni, Noni 65, foreign national, and Noni 58 for 5 to 8 units. So this is our bread and butter here at the lender. This is our favorite loan, certainly mine. And, and we just love it. That's why we have our Noni here for us all the time.
All the time.
Yes.
And Noni 58, I haven't seen 58 in a long time, but the Noni 58 is all right in my book.
That's right. That's right.
Okay, cool. You said a lot of things there. You could see I was taking down some notes. Okay, so
yes.
You say you guys are funding up to $200 million of Noni alone a month. Is that correct?
A month. Yes, by far our most popular product. It is probably the loan that made the lender famous. It really, in 2020, and, as I was talking about, Paul, we've only been around since 2018. 2 years into our genesis, This was rolled out and we never looked back. This is what we're famous for. We actually changed the whole industry with the NOMI. We were first to market with a simple DSCR product that you can do on volume, that you can close in a few weeks, 2-3 weeks without issue. So it is, especially now in this market from our real estate community, as rates are going up, the investment community has not slowed down at all. There are so many investors domestically and overseas who want to buy rental properties in America. It is so hot for that right now. The demand has not ceased at all. In fact, it's gone up for these investors to acquire rental properties. They're acquiring as many as they can. So we cater to that investment community by offering a simple loan, offering a simple process, offering, powerfully educated AEs to make sure that loan is going to close on time. And it is an absolute smash here with us. We are the best DSCR lender in the country for domestic and international investors.
Okay, cool. Let's talk about some details. First of all, the first thing we talked about was $200 million loans per month. That's great. And then let's talk about some qualifying criteria for domestic people, right? So, and then we're going to talk about equity. A lot of people have a ton of equity in their properties now. So it's a great time for them to pull out equity, do a HELOC, and come buy more properties and stuff like that. So you talk about 85% LTV, right? So that's all they need?
Yes, we can do the loan at 15% down.
Yes.
It has to DSCR at that LTV, meaning that we need enough rent to cover the mortgage payment and everything. But we can do it with 15% down. That loan, 15% down is probably better placed for like a duplex or a multi-unit, just because we want to make sure we DSCR. But, what's good about this is that, if it doesn't DSCR, that's okay, because we have the near NOMI that is right behind that, and that goes up to 75 LTV or 70% cash out. So, as long as our borrowers are aware, hey, this is how the loan is working, it's based off rental income. And you can prep your borrower and say, hey, if the rental income comes in, great. We can do whatever term the borrower would like. Interest only is 30-year fixed, 40-year fixed IO. We have a 5-year prepay for the lowest rates, but we can go down to 1 in our states. So we can it's really fun and it's an enjoyable loan to do from our side, because we have so many options for the borrower and we can accommodate them in any way that they would like. So that's kind of where the fun part is. And then at the end of the day, we let the borrower know, hey, if there's not enough rental income for this to DSCR, we'll do the near NOMI. We're just going to ask you to bring in, maybe 5% more down. Rate will be a little bit higher. But, as long as the borrower is aware of that and what could happen, the loans close. So yes, to your point, 200 million more or less, it just shows that these loans are very, very secure for investors right now, right? Because the rent covers the mortgage and the housing expense. That's a safe loan, and we've had very few historically over time, very, very few even forbearances during COVID or foreclosures or anything like that. So it is truly a phenomenal investment for these investors in the real estate market.
Okay.
Putting 15 or 20% down.
Let me tell you, last night I was looking at some statistics. I live in the expensive Bay Area. Okay, but not all the cities in the Bay Area, San Francisco Bay Area, are expensive. So I was looking at 2 counties. Okay, if you look at the peninsula, a little property in Palo Alto might be $4 million. Okay, but you go 1 hour away east. Okay, let's say you go to Pittsburgh or Rodeo in Contra Costa County, you can find the same property for less than $1 million. So now, and since you do up to 8 units, right, the person that has a ton of equity in the property in Palo Alto or Woodside now can pull some money out and go buy a property just 1 hour away, a multi-family, right? So realtors who are our primary audience can see this, say, how can you boost your business? Of course, you can boost your business. You know, this is a moment for you to go back to your past clients and provide service for them. And guess what? By providing that service and telling them they can pull equity out of their properties, they can now take that money and go buy a property elsewhere in the same state, only 1 hour away, a property that cash flows, right? So we try to bring value to real estate agents, and that's why we have the show, right? So any comment on that? Are you guys seeing the same thing in Southern California with a ton of equity in properties?
Absolutely. Everybody right now, I mean, certainly 99, I mean, I don't have any rate term refis. You know, everybody that I have right now, they're pulling cash out of their homes to buy more real estate. And, you know, from an investor perspective, that they have a huge advantage over anybody else trying to get into that home because they have the money and it's not like they're going to disqualify or can't be qualified at some point. So I'm constantly, you know, we have a client, they have a rental property, we're pulling out cash and they directly, immediately use that to buy another property. That is what this product is being leveraged for right now for the majority across the board, for sure. Yes.
So they can have a property that's an investment property and it has a ton of equity they can pull out, but they can also do for their primary residences, right? Because we have, let's say somebody's retired or somebody, you know, high net worth individual, right? You have some programs where they can do a bank statement loan on their property in case they don't have W-2 income. They can pull that money out also from their primary residence and go buy a property. Don't you have that kind of program?
Absolutely. Absolutely. And it, you know, goes with the primaries too. You know, a lot of people in this country have untapped equity. And this market is pushing people to act, right? Whether that's to pull out cash for reserves, pull out cash to buy more. So absolutely, that's what, you know, that's the trend right now. That's what everyone wants to do. Pull out cash from their primary. I had a flat tire today. My Uber driver going to work. We were talking, right?
Yes.
And he said, geez, you know, everybody, all these homes on my block, they're getting bought up and used as rentals. Now he wants to do that. So this is, you know, realtors and, you know, your borrowers who are not maybe active investors yet, they're starting to see investors coming through their neighborhood and buying up all these homes. So I spoke to this gentleman and he said, well, I don't know if I want to take cash out of my home because rates are high. And I said, well, that's a good point. That's one angle to look at. However, you also have to look with these loans, a lot of it, it's not about the rate, it's about the ROI, return on your investment. So even if you have to, you know, with properties accruing, you know, equity to 10 to 12% a year, that's a lot of equity annually, right? So even if your rate is 6% or 7%, or, you know, complex loan 8%, you're still winning. You're still getting that return on your investment. Even though the rate is high, maybe you got a higher rate on your primary home to take out the cash. Your ROI, your return on that investment is still is so much more than your interest rate. So that's a big factor, you know, for borrowers to understand. Investors will know that if they're experienced. New investors, you may just say, hey, you know, it's not necessarily about the rate. If you're investing, it's about your return on your investment. And that's what people are starting to see.
You know, that brought up a point, you know, so the equity in your property is unearned income, totally unearned. You didn't work for it. You just bought a house, you leverage. That's part of the American dream, right? You bought a house with very little down or maybe 20% down, and you sign on it, you pay your mortgage and stuff like that, you know, and over the years, even the last 2 years alone, maybe you gain 50% equity in the property. Because I remember, for example, when the market hit the bottom in 2012, that's when they, all across the board, any market they looked at, any city looked at, February 2012, that's when they reached the bottom. My city, for example, I live in Newark. The average property, single family residence in Newark was $352,000. Okay, Yesterday, I looked at my data. The average property, same property, 10 years later, okay, is what? Guess how much it is?
700,000.
No, 1.5
What?
million
Oh
dollars.
my gosh.
Where's this
That's
in Newark,
crazy.
Newark, New Jersey?
Newark, California. We are in
Oh,
California.
wow.
Okay,
Incredible.
go figure. The average property here where I live, okay, is 1.5, and that's not the peninsula. If you go to the peninsula over there, you cross the bridge, you know, is if you're in Palo Alto, that would be maybe 2.5, 3 million easily.
Wow.
Okay, it's crazy. So let's say you bought this property in Newark 10 years ago at the bottom of the recession, right? At $352,000, and now it's more than it's 5 times. It's five times the value.
Wow.
Incredible.
You bought a property, okay? So you bought it, and maybe you put down 10% or you put down 3.5% 10 years ago, and you got all the equity in the property, right? That is money you did not work for. And now Ray and Noni are telling you you can take some of that money out, put down as down payment for another property or several other properties, okay? Only 15%. You can go buy some, you know, in Stockton. You can buy in Sacramento. You can go out of state, Arizona. You can go to Florida and stuff. Those are inexpensive states. You take in just 15%, you know, that's your down payment. And those properties going to cash flow over there easily from day one.
Yeah.
So cash flow. So if a realtor is listening to this and they have past clients, they need to go back to their past clients because you're providing service to them. They did not earn that income. They did not. It's unearned. It's the easiest way to earn income, right? It's an American dream. In some parts of the world, people don't, there's no resale of properties. You buy a property and that stays in the family forever, right? You don't resell. In America, we sell. You use a property as a bank, become a bank.
Right. Yes. Right? Yes. Thank
right?
you, Paul.
Yeah. So that's exciting. Okay, now let's talk about more details here. Say if the PITI, okay, which is the principal, interest, taxes, and insurance, or if the rent is equivalent to the PITI, then the loan to value, okay, for purchase is going to be 85%, right?
Yes.
But if it's not, if it's like, okay, 7.75% or 75% of the mortgage, then you can go as low as what? Like 75%, and that's what you call Noni?
Yes. So yes, good question, Paul. So when we're in a situation and this happens, you know, yes, we can go up to 85% as long as that rent covers the mortgage payment and the selection that borrower made. You know, but we can go down to 80% on a Noni as well. So it's kind of strategizing with the client and saying, okay, well, you know, you're putting 15% down. Worst case scenario, do you have another 5% to put down in the event that we just don't have enough rent and we need to reduce the loan amount a little bit? So setting that right expectation with the borrower. So when it comes back, so let's say no matter what we do, we started with 85 DSCR, we took it down to 80, which is like, you know, kind of standard, and it still doesn't DSCR. That's okay, because at 75% LTV, we don't care what the ratio is. We can do that near Noni. Right. And still do whatever terms the borrower wants. Maybe it wouldn't DSCR or be a Noni on a 30-year fixed, but now if we do a near Noni, it doesn't matter. We're not worried about the ratio. They can do a 30-year fixed there. So even if you're in an area that won't cash flow, no matter what we do to cover that PITI or ITI, if it's going interest only, then we just simply set it up as a near Noni. Set the right expectation from the borrower from the get-go. Hey, if this happens, we need you to bring another 5% down. Your rate's going to go up another 0.5 point. So there really shouldn't be any fallouts. There's no reason why that purchase couldn't go through or that refi couldn't go through, as long as we set the right expectations for the borrower about what we're looking at to qualify the loan and what will happen if we do a no ratio loan. And as long as you set that right expectation for the borrower, how can your loan not close, right? Because we'll close it on a noni or a near noni, and it's a slam dunk either way.
Okay, cool. That's great. So are your rates for the 5 to 8 units, because those are considered like commercial, how are the rates different from 1 to 4 units, right?
Good question. So 1 to 4, the rates start today at 6.375.
Okay.
For 1 to 4 units. And just to touch on that, that's really, really phenomenal. Market, as Paul and I know, if either Paul or myself, or let's say a doctor with 800 FICO score who wanted to buy his primary house, he's looking at a 5.5.
Right.
So a no income doc rental loan starting at 6.375, holy smokes. So we're very competitive to market with that. Now for the 5 to 8, our rates start at 6.875, but there's different FICO buckets. We go down to 620, but we also go up to 760. So a lot of what I'm doing now is I'm pricing out cash outs, right? Because 5 to 8 was a totally underserved market, not many options. A lot of those properties are completely free and cleared. So and some of these stronger FICO scores that I have, even the max cash out LTVs, I'm in the mid 7s, which from my understanding is extremely competitive for somebody who's not a super AAA person with 800 FICO and can go to Chase Bank. Anybody who can't go to Chase Bank, that is a great rate for them, great program. And to touch on the 5 to 8 as well, a lot of that underwriting historically was complicated because there's expense rolls and stuff like that. For our loans on the 5 to 8 up to 2 million, we're not doing all that kind of super crazy underwriting stuff. Okay. We're just taking the rent from the units minus any management expense for loans up to 2 million. If you go over 2, they look for some mild stuff there, but that's another big feature of this loan on the 5 to 8 to get somebody a rate in the low to mid 7s and actually originating it for that client without your client pulling their hair out because they're providing you a ton of documentation.
Okay, so one thing is, very limited documentation. Let's talk about, because you have unlimited number of properties that they can finance, right? You said. So when now they want to finance a new property, are you going to require them to give you the mortgage statements for all the other properties, the 101 properties that they owned or not?
Very good question. So in terms of like what we do need to see on any NONI that the last 12 months that there aren't any lates in the last 12 months, no 30-day lates. Now, when you pull a credit report, a lot of that data is already generated on the credit report. So we don't have to necessarily grab all their mortgage statements or anything like that. We just simply ask for one recent mortgage statement just so we can tie it into that trade line.
Yes.
So, but also in this loan, a lot of your investors will have taken out hard money loans or private loans to purchase that. Right. We pay those off all the time because there's no seasoning on the NONI or anything like that. Okay. So when we get that, if it's a private loan, we just get a VOM, a simple form or statement from that private lender. It can be informal because private lenders are informal, right? Just saying, hey, they made all their payments on time. This is what their balance is. So if we can account for like a lot of the trade lines or mortgages on the credit report, we just get some simple stuff to like draw the map. We don't have to get their insurance information on those properties. We don't need the leases on those properties. Okay. We really don't care. We just want to see that the payment was made on time in the last 12 months. Aside from that, that's really the only qualification. From there, it's just, hey, let's get the appraisal, see what the market rent works, and see where we are with the DSCR.
That's good. Okay, so wouldn't the credit report show whether or not they were late in the last 12 months?
Absolutely. Absolutely. So a lot of times we just see what's on the credit report. Most of the data is there anyway, and fill in the blanks. Easy peasy.
Okay, cool. So one good thing that you mentioned also is no seasoning, because I used to do a lot of flips, and the killer is that you have all this high mortgage interest rates and stuff like that, and if you are late on one, guess what? The interest jumps to 18%. So we strongly encourage those flippers. Once your property is stabilized, right, and instead of selling it, at a loss, because we did some of those, right? You can now refinance it out of hard money and maybe you put on a DSCR, this noni, put on noni, and then you don't have the pressure to sell it so quick again, right? I mean, and then you don't need much documentation. So this is a great program. Wouldn't you agree, Ray?
100%. When I started the company in 2020, and I was in the first AE class to be trained on this product, I immediately saw that it is the perfect pair with hard money. I like to say that noni is soft money.
Okay.
Where, it's we get a little bit more documentation than hard money, but that's for a reason. So we can give them a conventional term, more of a conventional mortgage term, and a low payment. So that no seasoning, I work with borrowers and partners all the time where their investors buy a property off market, rehab it, they want to keep it. Great. As long as one of the original owners is going to be one of the applicants on our loan,
yes,
they can pull cash out of that property that they just bought off market and rehab, get their money back.
Right.
Pay off those hard money or short-term loans. And you know what? Their hard money lender is going to love that.
Yes.
Because and I have hard money partners who love the noni because they're like, oh, great. I'm going to get refi with noni, get my client out of this high-risk loan, get my money back, and free it up to lend to somebody else.
Exactly. They only got their money up front because they charge 2 points and stuff like that, and for you, you charge nothing, just the underwriting fee. How nice is that?
Yes. No points. So this essentially, they couple so well together that if you have that investor who has those hard money or does purchases distressed properties or foreclosure sales or what have you, you can say, well, you know what, Mr. and Mrs. Investor, I've got a great exit loan for you. Just buy the property. Yeah, get your hard money financing, whatever you need to do. Just fix that property up as soon as you can. As soon as we can get a clean appraisal on that home with no subject to repairs and everything's good to go, ready for a tenant to move in, let's refi it into a noni, pull your cash out if need be. If you put $100,000 into the home in the last month, that's fine. We're just going to need the appraiser to say, hey, this is what they did. And this is where their $100,000 went to. So even if it's a really quick turnaround and they put a ton of money and that property's worth a lot more, we're just going to have the appraiser make some notes. And even if they did everything within 60 days, we're going to accept that new value of that property, which is a huge, huge thing. A lot of lenders won't let you do that. A lot of lenders will say, no, you just got it. We're not going to use the new value till 6 months or a year, or whatever. As long as we get a new appraisal and we get some notes on there, some good notes, we're going to use that new value, and that client's going to love you. Refi them out of that hard money so they can get their next property.
I know that for sure because we're working on a deal right now, actually 2 deals, right, of that nature that, our clients closed, using hard money in April, and now, we got a new value for one of them, and we're expecting the other one too, and could just refinance out. You don't even need, some people say you got to wait 6 months, do a cash out refinance, but you can do it, and say, hey, listen, what is the real value? It's like that delayed financing that some people have, so you're doing this. I mean, you can refinance a property right away and get the first money. Why not? Somebody can get a property which is off market, like these ones were, right? And you have investors. Investors are listening to this. It's not just for realtors, right? If you're an investor, you're listening to this. You are hot. I mean, you're a flipper and stuff like that. Or you are a landlord, and people are bringing you deals, right? Off-market deals. The noni is the best solution for you. You don't need to be stuck in hard money. You can get soft money with very little documentation, right? That's great. So, Noni and Ray, it was a pleasure having you on the show today, and I can't wait to have you again next time. Next time I'm gonna have I'm gonna have other realtors join us. So I can have on the show. It's not just gonna be me talking to you guys, so that they can have questions as well. We can grow this thing and blow it up. And guess what?
Au revoir, mon ami.
No,
Au revoir, mon ami.
Il faut chanter encore. Chante.
Oh, merci.
No, chante. Chante.
Noni, hey, do you want to?
I said sing
Do you
again.
want to show them your jacket?
Sing a
Oh,
song.
do you want to see my
Yeah, gotta see
jacket?
your outfit,
I wanna see
Paul.
your
You
jacket.
gotta
Oh,
see your outfit. Look at that.
I know. No,
Noni, let's go. Let's go.
Noni approved. Okay, there you go. Noni,
Approved.
Noni, Noni approved. And look at that. I'm wearing
all right.
Paul, we're gonna get you this jacket, okay? We're
Yes,
gonna get you one of
exactly.
these jackets.
of
Wear it
course a
next
big
time.
size. A big size, Paul, right?
Yeah, I got a fat neck. Look at that.
I got
Don't
a
open up the collar.
I got a skinny one. A real skinny neck.
So Noni, can you sing that song again? The opening
Which
song.
one? The
opening
French song?
Yeah, the French song.
Oh,
We'll
la
close the
vie
show
en
today.
reprend, il me prend dans ses bras, il me parlait tout bois, je vois la vie en rose. Il me dit d'un mot d'amour, deux mots de tous les jours, et ça me fait quelque chose. Il est entré dans mon cœur, alors de son ombre, I forgot all the words. C'est lui pour moi, lui dans la vie. Il me lâche, lâcherai pour la vie. I forgot I gotta learn the words.
Next time we'll do this show.
Mon cœur qui bat, la 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 la. Mon cœur qui bat.
There you go. Thank you so much. Merci bien. Merci bien. Okay, au revoir.
Au revoir. Thank you, Paul.
Enchanté.
Thanks, everybody.
Bye.
Thanks, Paul.
Bye-bye. We'll talk to you next time.